What's up, everybody? Today we're going to be talking about mortgage insurance and the different types there are and whether it will be a good idea for you to get it or not. So first of all, let's talk about the two different types of mortgage insurance. We have Pmi, which is private mortgage insurance, all right, and then we have Mi, which is just mortgage insurance. Pmi is a thing you'll see a lot, and generally when you have a second mortgage, there's Pmi. If you don't have, like, if you have like an FHA or any non-conventional loan, you'll end up having to pay Pmi more than likely. So what Pmi is, like I said, is private mortgage insurance, and it guarantees the lender will get their money back in the event of a default. So you can actually kind of see the scam right there. Like, immediately that came to me. So let's say you finance a house. I don't like to say buy, because really, if you didn't just pay it off, buy cash, did you buy it? You financed it. You don't really own it. The bank does. Let's say you finance a property and you get a non-conventional loan. So you get like an FHA loan, and now you have Pmi. So let's say you default on the loan, you stay in the house 5 years or whatever, and after 5 years you default and you end up foreclosing. So what happens is the bank will gain possession of the property again, and they will resell it. In times like this, I've seen banks get a house that had where the previous owner defaulted on $180,000 and then turn around and list the house for $530 and it's selling a week. Not only that, they had Pmi on there too. So let's say they had a non-conventional loan and they also had Pmi on it. I know for a fact though that they had a non-conventional loan in this example I'm speaking of, because it was a HUD home, which means there was an FHA loan, and so the bank got compensated for the default. Then they turned around and sold the house for a mighty profit. And then on top of that, they still got several years of payments. It's amazing how much they make money. Now, I just want to say this sidebar, because there's so many people online right now looking at how to make money online, how to make money, and how should I invest and all this. But people don't really want to invest. They're looking for short-term gains, and that's always going to make you lose. You got to stop doing that. This is why I always preach, do what you love, because you can do that long-term without getting worn out. You cannot keep something up and lead a fulfilling life if you don't like it. And nobody likes trading stocks. Like, that's a means to an end. Like, no one just enjoys that stuff. So anyway, they get paid so many times, but you see how that scam, how it works out. But I don't want to call it a scam, but it is. They're getting paid 3 times when people default, as long as the market is good. Because sometimes they have to sell them at a loss, like 2010, 2011, 12, you were seeing stuff being sold. They were just trying to get stuff off their books. But again, if they had Pmi, they more than likely got their money out of it, then they still got years of pay. So they still profitable. The banks are profitable, but that only works when they have a long-term mentality. All right, they're not looking to just get rich tomorrow. They're like, look, we're going to pace ourselves and we're going to build this out, and over time we'll be killing it. And they do. So that's Pmi, y'all. So moving on to Mi, which is just mortgage insurance. Now this is for you. So this is something extra that you can purchase. And by the way, Pmi costs money. You pay for it every month. It's just wrapped up into the loan, so you don't see it. So you're paying it, all right? You're paying some form of insurance regardless. So mortgage insurance, though, and I guess there's a third. There's just, property insurance. What regular property insurance is. There's, a hurricane to blow the roof off the house or whatever. You get your house repaired and you file an insurance claim. But mortgage insurance is a form of life insurance that pays off the house when you die. This is good to have for your heirs. Now, some people might say, and there's a couple things you could do to not have mortgage insurance, but some people might say, I just have regular insurance. I just have regular term insurance. The problem with regular term insurance is that it expires. And I'm not trying to get too deep into different versions of life insurance, which we could do because I used to sell life insurance. but that expires. Mortgage insurance, which is funny because, your average mortgage is what, lasts 30 years. So it's kind of the same thing. It's basically a term policy, but it's cheaper though because it's just looking at the balance of the property. And generally it is just, it's cheap. And in some cases, if you do it right, so let's say you're an older person, let's say like my mother, for example, either one of them, they're both older and it's no way they're getting a good rate for regular life insurance. But if they refinance their homes, like right now, banks are real desperate. 9 times out of 10, they'll get a notice in the mail saying, hey, if you want to just add this mortgage insurance, just check this box and we'll just add an extra $100 or something or whatever to the mortgage. That's it. Now, it's an easy way to get coverage, right, when you're really old. So in those events, I recommend getting them. And it's also, especially if it's on a rental property, that stuff is tax deductible. So get that. That's like one of the only times where life insurance can be tax deductible on your personal. Now, I know some people say, well, I have a regular term policy and I'm going to leave my kids cash. Okay, they get cash money. Okay, well, the problem with doing that is they're not going to use that money properly and they're going to run out and they're going to lose the house anyway, okay? I mean, you really got to be careful because they might lose the house behind not paying the taxes, all right? You got to make sure that your kids know all the expenses that go into owning a home. They could lose it to maintenance and it just fall apart. I recommend leaving a house paid off. If you can also leave some cash, it's fine, but you don't necessarily have to do it in the form of insurance. You could just put some money aside in stocks or whatever and make sure they get that pays out dividends, and you can create and set up an annuity for them. That oftentimes, especially when you're dealing with kids that aren't good with money, that's how you want to set it up. You want to make sure they have a place to stay, and then they get a little allowance every month, $2,000 or $2,500, something like that, to make sure all their bills are paid and they can be safe and secure, but not enough so that they don't have to do anything. I'm not saying they make them go work, but at least work for themselves, do something, and give them that ability to do something that they love, so that they can eventually profit from that, sharing their gifts and talents with the world. So anyway, that's the video, y'all. Just wanted to talk about the differences between different insurances on mortgages and on properties. And hopefully that's clear. If you have any questions, just ask them in the comments below. And I'll see you guys next time.